We want to continue our discussion on leases, that is IFRS 16. We've already looked at the introduction aspect of leases. We've also looked at leasing accounting. We have these videos or lessons already on the channel. So if you want to appreciate or continue to appreciate what we are coming to do today, you barely have to go and understand the preliminary things in leases and how leasing account for a lease contract. We look at what is the meaning of leases, the item or what differentiates a leasee from a lessor. In case a contract contains a lease contract and a non-lease contract, how do you even separate them? We look at all those things. And leasing accounting, we've indicated that leasing must generally account for two things. That has to do with a lease liability and a right of use asset. But there are some exceptions when the lease contract is of a short term, and then the lease for which the underlying assets is of a low value. When that is happening in the question, then the leasing may be prevented or may not be required to account for leasing accounting and the right of use asset. We've looked at all those things in there under the leasing accounting. We've also looked at what I mentioned earlier under the introduction aspect. So you can have a watch of those videos to appreciate today's discussion. Today, we want to continue the discussion on leases by looking at how a lessor accounts for a lease contract. How a lessor accounts for a lease contract. That is our focus for today. So we are still looking at IFRS 16. That is leases. But we want to look at lessor accounting. We want to look at lessor accounting. How a lessor accounts for a lease contract. Please, if you have not subscribed, kindly subscribe to our channel and also share it with others so that we can reach the wide, learning community. The only thing you can do to support us is by subscribing and sharing our videos with others. Thank you. So, like I indicated, we want to look at how a lessor will account for a lease contract. Anytime there is a lease contract, in fact, the parties involved is the lessee and the lessor. How does the lessor account for that contract? That is what we want to look at. How lessee account for a lease contract is different from how a lessor account for a lease contract. Now, if you look at the provisions in the previous standard, that has to do with IAS 17, how lessor accounts for a lease contract has not changed in the new standard, the new accounting standard. So, lessor must account for either one thing or the other, not the two. Either one thing or the other. So, lessee always account for two things, in exception of when the lease is having a short term or the lease asset is of a low value. But when it comes to lessor accounts for just one thing or the other. So, in a lease contract, lessor either account for what we call finance lease, or to either the lessor account for finance lease or what we call operating lease. So, lessor account for either a finance lease or an operating lease. One of them, not the two, one of them. So, when there is a lease contract, the lessor, in fact, if you get a question and it is in the perspective of the lessor, the one who is providing the lease assets to lessee to the other party for exchange or in exchange for consideration, that party is the lessor, the one providing the lease asset. That party, which is the lessor, must check if that lease contract is a finance lease or an operating lease. Is a finance lease or operating lease. So, lessor will basically account for a lease contract and a finance lease or an operating lease. Now, how do we know that a lease contract is a finance lease or a lease contract is an operating lease. The standard indicated that when the risk, in fact, this is a general statement. This is a general statement. How to differentiate finance lease from an operating lease. The general statement is that when the risk and reward, in fact, when substantially the risk and reward incidental to the ownership of the lease asset is transferred to the lessee. When the risk and reward, in fact, substantial risk and reward incidental to the ownership of the lease asset is transferred to the lessee. That is a general statement. If that is the case in the question, and we are saying that that is a lease, in fact, a finance lease. So when the risk and reward that are incidental to the ownership of the lease asset is not being transferred to the lessee, then we say the lease is an operating lease. Now, what is this risk and reward being incidental to the ownership? What it simply means is that anytime there is a lease contract and then the maintenance, the insuring of the lease assets is in the hands of the lessee. In fact, how to take maintenance of the lease asset, how to make sure that the lease assets, in fact, the identifiable lease asset or underlying asset works properly. If it's in the hands of the lessee, then we are saying that substantively or substantially, the risk and reward have been transferred to the lessee. And for that matter, that lease is a finance lease. But with this alone, we cannot, judgmental. We cannot be conclusive if certain other items are not considered. So the standard proceeded to give us 8 different conditions, 8 different events that can help us to identify whether a lease is a finance lease or a lease is an operating lease. 8 different conditions or 8 different events that when they do happen in a lease contract or a lease transaction, it will aid us in knowing that the lease is a finance lease. Let's look at those 8 items. So after that, when we are done with identifying a contract that is a finance lease and a contract that is an operating lease, then we look at how a lessee will account for a finance lease, because it will be different from how a lessee will account for an operating lease. All right. So the 8 items that indicate that the lease contract is a finance lease. Number one. So number one has to do with when the underlying asset, in fact, the lease asset will be transferred. Ownership of the lease asset will be transferred to the lessee at the end of the lease term. When the lease asset will be transferred to the lessee at the end of the lease term, then we are saying that that particular lease contract is a finance lease. Please, these 8 items we are coming to look at, they are not mutually exclusive. All of them might not be present before we say that the lease contract is a finance lease. Even if one is present, it is a finance lease. Okay, so the first one has to do with when ownership of the lease asset is transferred to the lessee at the end of the lease term. 2, when or if the lessee will have the purchase option. Okay, so if the lessee have the purchase option to purchase the assets at a price that is substantively lower than the fair value of the lease asset at the exercisable option date, and we say that particular lease is a finance lease. When the lessee is having the purchase option, do you remember when we were looking at lessee accounting, when we're determining the initial value of a lease liability, we indicated that one of the items that constitute the lease payment is the option to purchase the lease asset if the lessee is reasonably certain to exercise that option. So here it is coming here as 2. If the lessee has a purchase option to purchase the asset back at a price that is lower than the fair value of the asset, we are saying that the lease is a finance. Remember that options are contracts entered into today, of which they are executed in the future, but their prices are determined today and they are executed in the future. So if that price is going to be substantively lower than the fair value of the asset, then we are saying that that is a finance lease. So this has to do with the purchase option. The purchase option. Alright. Then 3 has to do with the lease term. The lease term. If the lease term is of a major part of the economic life of the lease asset, then we say it's a finance lease. So let's assume the lease term is 6 years, and then the useful life of the asset is 8 years. So 6 years of a lease term, 8 years of economic life. We say that the lease term is of a major part of the useful life of the lease asset. When that happens, we say it is a finance lease. On the contrary, if we are having a lease term of 6 years and then the economic life is 50 years, you can say that that is not a major part. So that becomes an operating lease. Once again, the items we are looking at are not mutually exclusive. Even if one of them is present, we are saying that it is not a finance lease. Number 4, that is the feature or the event number 4. At inception, if the present value of all lease payments amounts to substantively all the fair value of the lease asset, then we are saying that it is a finance lease. At the inception date, if the present value of all the lease payments substantively amounts to all the fair value of the lease asset, then we are saying that that is a finance lease. So if you computed for the lease present value and you compare it with its fair value and it's almost the same, then we are saying that that is a finance lease. That has to do with the present value of lease payment. Present value of lease payment. Then the 5th one has to do with special lease assets. Special lease assets. So the 5th one is when the lease asset is of a special nature and it can only be used by the lessee without any major modification. So for instance, the operation of the asset can only be done by the lessee. When that happens, we are saying that it is finance lease. In fact, this is the 5 main events, but the standard proceeded to give us additional 3 that you might see in questions or in the contract that indicate that lease is a finance lease. Let's add the last 3. The last 3 there, that will be the 6th one. The 6th one is saying that if the lessee cancels the lease, if the lessee by any means cancels the lease, and then the lessor losses associated in the cancellation is borne by the lessee. If that happens, we are saying that the lease is a finance lease. So the lessee is cancelling the lease, but the lessor losses associated in the cancellation will be borne by the lessee. If that happens, we are saying that that lease is a finance lease. That has to do with the 6th one. So this has to do with lease cancellation by who? By the lessee. By the lessee. Lease cancellation by the lessee. That happens, the lessor losses as a result of the cancellation will be borne by who? By the lessee. If that happens, we are saying that the lease is a finance lease. The 7th one. The 7th one has to do with when the gain and losses from the fluctuations of the fair value of the residual accrue to the lessee. So let's go back to the lease liability. How to determine the initial value of a lease liability. We said that one of the items that constitute the lease payment has to do with the amount payable by the lessee under residual value guarantee. If that residual value fluctuates, its fair value fluctuates, and those fair value fluctuates is giving rise to either gain or loss of fair value, and it accrue to the lessee, then we are saying that that lease is a finance lease. So in simple terms, 7th point is saying that when the gain and losses, the gain or losses from the fluctuations of the fair value of the residual accrue to the lessee, then we are saying that that lease is a finance lease. That has to do with the fair value of the residual. Then the last one has to do with when the lessee has the ability, has the ability to lease the asset for a secondary period. When the lessee has the ability to lease the asset for a secondary period. So for a second time, maybe the first term is ended, but the lessee has the ability or has that kind of right to lease the asset again for a secondary period at a rent that is substantively lower than the market rent. That happens, we say the lease is a finance lease. When the lessee has the ability to lease the asset for a secondary period, but at a rent that is substantively lower than the market rent, when that happens, we are saying that the lease is a finance lease. So the last one has to do with renting or leasing the asset again. Okay, so leasing the assets again, leasing the assets for secondary period, leasing the assets for the secondary period, and the rent that the lessee will pay for the secondary period is lower than the market value or the market rent, then we are saying that that is a finance lease. So when all these 8 items or 8 features are happening or are in a particular lease contract, we say that that lease is an automatically finance lease. In fact, if any of these is absent, then we are saying that it is an operating lease. Don't forget the general statement that gives rise to a finance lease. That is when the substantively the risk and was ownership to the is incidental to the ownership of the lease asset is what is with what the lessee, then we say the lease is a finance. That is the general statement. But these ones also helps us to know that the lease is a finance lease or the lease is an operating lease. Having understood or having know how to distinguish between a finance lease and operating lease, how does the lessor account for finance lease and how does the lessor account for an operating lease? Let's look at that. So how does the lessor account for the finance lease? The lessor accounts for the finance lease using what we call the net investment in the lease. The net investment in the lease. The net investment in the lease. Now, with the lessor accounting for the finance lease, in fact, the lessor accounts for the finance lease as net investment, which is basically known as the receivable in the lease. Receivable in the lease. So, which is basically the net investment in the lease. Now, what constitutes this net investment in the lease? It is basically the same way we determine the initial value of our lease liability. So what constitutes the net investment in the lease is basically the same way we determine our lease liability. So I will not waste time here. Once you understand how we establish the initial value of our lease liability, it's the same thing here. It has to do with the fixed lease payment, the fixed lease payment. We also look at the variable lease payment that depends on an index. We also look at amount that is payable under residual value guarantee, the option, the exercise price of a purchase option. When the lessee is reasonably certain to exercise that option, termination penalties, all those items we looked at also form part of what in determining the net investment. But here you have to also take into consideration the amount that is expected to be payable under residual value unguaranteed. We said that with residual value guaranteed, it is when the party or a party that is unrelated to the lessor or the lessee is promising the lessor that at the end of the lease tenure, the value of the asset will be this. That is the residual value the residual value guaranteed. But if the lessor himself or itself is saying that at the end of the lease contract, this is the amount I'm expected to get for my lease, this is the amount I'm expected to value my lease, that becomes a residual value unguaranteed. If the lessor is the one making the pronouncement, it becomes a residual value unguaranteed. But if it is a lessee or a party that is unrelated to the lessor, it becomes residual value guaranteed. All must be captured under the net investment when we are looking at the lessor accounting. This will be the initial value of the finance lease. Then subsequently, you amortize. Remember, the amortize here also depends on whether the payment is done in advance or the payment is done in arrears. All of these has to do with the initial value of the finance lease. After that, the subsequent measurement will have to do with the amortization of the initial value. Okay, so once you've done that, if you do the amortization, remember you are going to get your finance income and then you get your closing balance or your closing balances over here. So your closing balances, in fact, we've dealt with this already under leasing accounting. That's why I'm not going to go over them again. Once you understand what is done in the finances, there's no need for you wasting or time. That's what I'm going through. So I took my time under the leasing accounting to explain all those things. So subsequently, the closing balance here, you have to split it into current assets and the non-current assets. The same way we split the lease liability, in the same way you also split this one. So I'm not going to waste time over it. So this is this is how we account for the finance lease, just as we account for the lease liability under the leasing accounting. Then operating lease. The standard says that under the operating lease, we are going to take full questions under leasing accounting. We'll take full questions under lessor accounting and then sale and lease back. Under operating lease, the lease payments are treated as on a straight line basis. The lease payments are treated on a straight line basis based on the lease term. Based on the lease term, or we use another systematic basis. If that systematic basis is more prudent and more reliable, will provide more reliable and relevant information than the straight line basis. So what it means is that if the lease is an operating lease, the asset will not be found on the statement of financial position. It will barely be treated in the statement of profit or loss and other comprehensive income. So if we are looking at maybe 2 years lease. Let's say the first payment is $10,000. The second payment is $20,000. What the standard is saying is that we sum out these two to get a total lease payment of $30,000. Now we divide it by 2 because the lease term is 2. So in first year, we will take a lease income because it's the lessor. So we will take a lease income. In fact, a lease income of $15,000 to the profit or loss account in the first year, and then a lease income of $15,000 to the profit or loss account in the second year. That has to do with the treatment of what operating lease on a straight line basis. So this is the end of how a lessor must account for a lease contract. How a lessor must account for a lease contract. Remember, I indicated in our introduction video that in leases or IFRS 16, there are 3 basic things we are looking at: the lessee accounting, the lessor accounting, and the sale and lease back. So our next lesson will be on the sale and lease back. How do we account for a sale when the lessee, who is the seller, sells to a buyer, and that transaction is meeting the provisions of IFRS 15, revenue from contract with customers, is meeting that provisions over there. Then the lease contract can be accounted as a sale and lease back. Thank you.